From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. A bit of a range-bound market as people parse through good news. Is it bad news with the Fed on deck tomorrow? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, futures steady as stocks close out the worst October in 5 years. The Fed kicking off its two-day policy meeting, and the Bank of Japan allowing yields to climb above 1%. We begin with the big issue. Here comes the Fed.
The Fed is going to hold
the course.
We'll have a more hawkish hold.
Hawkish hold.
A very hawkish tone, but a pause.
I think it's pretty much consensus.
We're not expecting a surprise.
High for long will still be an important part of the narrative.
Beating that drum of higher for longer.
They are also not talking about rate cuts, and we are not expecting rate cuts to come.
The continued strength of the economy actually handcuffs the Fed.
The economic data in the U.S. has been quite resilient.
The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong.
It's an extremely tight labor market.
The Fed is looking at all of these data juxtaposed with inflation that's still too high.
The Fed is probably going to want to keep its options open to hike more.
The Fed may still need to take some policy action.
There is still more work to be done.
That's the thing that's perhaps keeping me up at night the most.
And perhaps keeping up as well some of our guests joining us now to discuss. Kathy Jones of Charles Schwab and Troy Kayeski of FS Investments. Kathy, how important is the Fed meeting tomorrow?
Well, I don't think any big surprises will come out of it. As your panel just showed, everyone's expecting the Fed to remain on hold, keep the door open to further rate hikes. Whether they actually hike rates again is a question mark, but I think that the communication is still that inflation's too high and the Fed will want to, give themselves the option to tighten further if necessary. We happen to think the Fed is probably done for this cycle. It'd be a little bit surprising to us if the Fed were to hike again in December, but it's still out there as a probability. So unless Jay Powell diverges widely from that narrative, I don't think this Fed meeting is a big market mover.
Troy, do you think that perhaps the Fed has lost the narrative in terms of being the driver of it rather than just following market moves and economic data?
Yeah, at this stage of the cycle, data dependency means data dependency. And obviously, they've been trying for a long time and finally were successful pricing cuts out of markets. It was, rather entertaining to watch markets price in aggressive cuts through this year, not only next year. And obviously, they've gotten a substantial bear steepener. They've gotten multiple compression, a little bit of spread widening. So financial market conditions have tightened substantially. So they do have the room to sit back now and not be overly aggressive. And, we agree with Kathy, they're more than likely done. That being said, if inflation picks back up as it has recently, at least they have the flexibility to hike. Yeah. Until then, they're going to follow the data.
The news you need to know. Data dependency is data dependency at this point in the stage. There is a question, Kathy, and I joke because it's true. At this time, maybe they actually mean it. But the data we got out just about a half an hour ago really has to do, Kathy, with employment costs going up more than people had expected. How much does that raise your concern and make you question your base case that the Fed has done?
Yeah, I think the ECI is important. We know the Fed follows it. It is, if you parse the data, and I only had a few minutes to look at it in detail, but it looks like the biggest wage gains continue to be in professional services, insurance, finance, et cetera. And actually, some of the key service sector areas like leisure and hospitality, the wage gains were lower, notably lower than they have been for a while. So I think the overall trend is in the right direction. I don't anticipate at this stage of the cycle, given everything that's going on with the layoffs that we're hearing about and the job postings coming down, that we'll start to see some surge in wages. So I don't think that's going to change the narrative or the direction of the Fed at this stage of the game, but it can prolong the cycle simply because the Fed will be on hold for longer as we go into 2024.
Troy, I'm curious from your vantage point how much stocks are still in the clutches of bond market volatility that has far outpaced anything we've seen in the equity space.
Yeah, I mean, bond market volatility, fixed income volatility in general has been off the charts this cycle. The back end of the curve is definitely driving multiples in the short term or valuations in equities. You know, if we get further bear steepening, there's almost no doubt that we'll compress by a half to another turn. But then, of course, in the background, and this is one of the reasons the Fed probably should not heighten further, is they continue to drain the balance sheet really close to target. Money supply continues to shrink. So, you know, sit back, let inflation gradually cool, understand that there's going to be fits and starts, but don't be overly aggressive and cause another market accident.
Sit back, relax, and enjoy the central banks. There are a lot of central banks in focus this week. The Bank of Japan loosening its grip on bond yields with policy decisions from the Fed and Bank of England still to come. Joining us now is Bloomberg's Michael McKee. Some interesting developments overnight heading into all the drama.
Yeah, absolutely. In Japan, the Bank of Japan did as was leaked prior to the meeting and tweaked their yield curve control program. But it's more of a tweak than perhaps people anticipated. Bank of Japan loosening its cap, no longer setting a cap. 1% is now the reference rate rather than the cap level. So the market could push, and you can see in the overnight index swaps there, the market is pushing the yield higher than 1%. Those red dots on the white line are where the Bank of Japan has changed its yield curve control policies. And you had asked Troy about whether the bank is letting the markets dictate. The markets are dictating in Japan, and they pretty much have to now with inflation where it is. In the U.S., we did get the ECI number. Not really going to affect the Fed. And you can see over on the left-hand side, completely flat for November. The markets do not think the Fed will raise rates. There's still a little bit of a chance of another rate rise priced in for the next couple of meetings. But then the market still thinks we're going to see big cuts next year from the Fed. Will that change after tomorrow's meeting? And then, of course, the final question for everybody here today is the Bank of China, People's Bank of China. A lot of people hadn't focused on that. Xi Yi of the Bloomberg MLive group put this chart out. This is something to watch. The Chinese yuan volatility rate, the fixing rate, has dropped to 0. And look at how it has moved between 2015, when they revalued the yuan, and today. So if they have essentially repegged to the dollar, then they're going to want to buy Treasuries in order to keep that peg. And they, according to Brad Setzer at CFR, they have the money to do that, and they could do that. So it looks like the Chinese may be setting up for a new regime. We'll keep an eye on that. And that's one central bank thing, Lisa, that a lot of people haven't focused on yet.
Michael McKee, fascinating. Thank you so much. There's a larger question here that kind of raises, which is how much are the cross-border flows mattering more than some of the economic indicators that we keep clutching to? Kathy Jones and Troy Gajewski are still with us. And Kathy, I'm curious from your vantage point, how much the refunding announcement that we're going to get from the U.S. Treasury Department tomorrow, that the idea of the Bank of Japan potentially allowing investors to stay in that country rather than going to the U.S. for yield, how much those dynamics are taking precedence over economic ones?
Yeah, I've been pushing back against the narrative about Treasury supply being a major driver. Not that it doesn't matter, it does matter, but in this environment, I think what's been the big driver has really been the surprising performance of the economy. So if you look at the Citigroup, surprise index, economic surprise index, you plot that against 10-year yields over the last 6 months, you see a pretty strong correlation. I think that was probably the main driver. Supply usually isn't the big driver. It's usually not a big surprise. And keep in mind, even with Japanese nominal rates rising, real rates are coming down because their inflation's picking up, while our real yields have been high and staying high, and probably will rise even further, even if the Fed doesn't do anything, because inflation is coming down. So I think there's a lot of a constellation of factors that have driven yields higher. But I think at the end of the day, the big thing is, what's inflation doing, what's economic growth doing, and what's the Fed doing? Those are probably the key factors to watch. And the rest of this is just a lot of extra input right now and keeping volatility high.
Troy, do you agree with that?
Yeah, well, look, I mean, there's plenty of good fundamental reasons why we're in a higher for longer regime, and we've had a very steeper, stronger economic growth, more persistent inflation, a Fed that's not cutting anytime soon, despite what the forward markets are pricing in. But the technicals do matter at times. And, right now in particular, when you have the largest buyer in history, the Fed, being the largest seller in history, you have a banking industry that's really cautious about stepping in as rates go up because of all the book value destruction. And you just don't have as much foreign demand as we did, say 5-10 years ago. The technicals arguably matter more now than say 6-12 months ago or 3 to 5 years. But certainly at the end of the day, inflation expectations, inflation, strength of the economy tends to drive the show in the yield curve.
Do you think that, Troy, there is a susceptibility right now based on market positioning to a massive short squeeze within the Treasury market, just based on how volatile things have gotten and the fact that more people are suddenly throwing out 6%, 7%? I mean, there has been a real bearishness embedded into a lot of market positions.
Yeah, no, it's a great observation. I mean, it's very similar to equity markets, right? And that equity markets don't go down in a straight line. They don't go up in a straight line. We had substantial multiple compression, very strong rally. You look at the 10-year this cycle, we got to 3.25, rallied back. That's it. The Fed's done. Got up to 4.25, rallied back. Now we touched 5. We are in the middle of a relief rally, partially driven by positioning. And to your point, liquid markets tend to swing back and forth between, panic and fear. And a lot of the prognosticators that were very confident that the Fed was going to cut soon are now calling for 5.5 or higher 10-year yields, which could happen certainly with this fundamental technical picture. But a flat yield curve, 5.25, 5.5 makes a lot more sense than a 6 or 6.5% 10-year right now.
Kathy Jones, Troy Gayeski, both of you are sticking with us. And Kathy, I will let you get a final word on that coming up. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
Well, Lisa, let's take a look at two stocks that are dragging, one that is helping out the major indexes. Starting out with the shares of Caterpillar, they are down despite a very solid profit beat. What investors don't like is the fact that its order backlog decreased $2.6 billion from the second quarter. That stock down 6% in the pre-market. Sarepta Therapeutics absolutely plunging down 43%. If these losses hold, it will be the worst day since 2021. And this as a gene therapy, a trial with Roche for Duchenne muscular dystrophy failed the primary endpoint. And then to the upside, Pinterest up 15%. Investors and analysts very encouraged by the fact that there was solid profit margin and that revenues grew, Lisa.
Thank you so much, Abigail. Coming up, the Fed taking a back seat to the Treasury's new borrowing plans.
The Fed basically has outsourced monetary policy to the Treasury. I mean, we have the bond market, doing a lot of the heavy lifting.
I guess we can call it a Super Wednesday that's on deck with Chair Powell and the Treasury Department at the fore. That conversation coming up next.
The Fed basically has outsourced monetary policy to the Treasury. I mean, we have the bond market, doing a lot of the heavy lifting. Term premium has risen, and its backup in long-term rates is one of the reasons why the Fed probably will skip hiking this meeting. We do get a bigger supply announcement than what the markets are expecting, and markets are really fearful of who's going to take down all this paper into year-end when balance sheets are getting very precious.
Wall Street isn't just focused on Wednesday's Fed decision. The Treasury's refunding announcement taking center stage thanks to a recent run-up in yields. Traders broadly expecting a record $114 billion in refunding. The plan could see auction sizes increased for all but the longest debt, as the federal deficit is expected to climb above $2 trillion in fiscal 2025. Meanwhile, the Treasury reducing its estimate for federal borrowing this quarter, easing some deficit-related concerns. Joining us now, I'm so pleased to say, Bloomberg's Kayleigh Lyons. Kayleigh, I want to start just with where people are thinking the Treasury is going to come out tomorrow with this announcement in terms of just how much money needs to get borrowed through the Treasury market.
Well, as you said, Lisa, $114 billion for next week's sales of 3s, 10s, and 30s is what is anticipated. But tomorrow really is going to give us that finalized picture of what supply is going to be looking like, knowing that the Treasury has had to issue a lot more debt because the deficit is rising. Already in the year through September, $1.56 trillion of bills on net have been sold the year through September. So this really is what the bond market is bracing for. Now, of course, against the backdrop of yesterday's announcement from the Treasury that $776 billion is their new quarterly borrowing estimate for this period. That's down from about $852 billion. Primarily that cut driven by higher than expected revenue projections because of deferred receipts from states like California and others where they've had natural disasters and were granted extensions. But still, despite the reduction in that borrowing estimate, the new projection still marks a record amount for the calendar fourth quarter. And of course, as the bond market considers what the Treasury is going to do here, it's as we see 10-year yields just off of that 5% level we reached earlier this month, still hovering around the highest we've seen going back to 2007. And of course, what's interesting is Treasury Secretary Janet Yellen was here at the Bloomberg Bureau in Washington just last week, Lisa. She was asked about the moves we have seen in the bond market, and she thinks the higher yields are reflective not of the higher federal deficit, but instead of strong U.S. growth and rates that are going to have to stay higher for longer. But of course, not all market participants are agreed with her on that.
Kayleigh, just quickly here, I'm wondering how much this is what's hanging over the discussion about fiscal support behind some of the conflicts that the U.S. is getting more and more involved in, including Ukraine as well as Israel.
It very much is for the Republican Party, Lisa. A lot of conservatives would like to see more fiscal discipline exercised here in the U.S. And, of course, on the case of Israel funding, which the White House has requested about $14 billion from Congress, the House Republicans unveiled a bill just yesterday that would effectively offset that by cutting more than $14 billion in funding from the IRS. That's not something we usually see with emergency funding requests, but it speaks to the idea that that party would really like to see this deficit brought under more control.
Kayleigh, thank you so much. And we have been talking about that with our panel, who still is here, Kathy Jones and Troy Gajewski. Kathy, I know we were talking about how you've been pushing back against the sort of deficit questions around the bond market, but there is larger uncertainty kind of hanging over the market. Do you think that there is a lesson to be taken away? The Treasuries no longer are the havens that they once were during times of uncertainty and conflict.
Well, I think that's a big step to take from here. And so, you buy U.S. Treasuries, you're still going to get your principal back at par and your interest. And that's not true in a lot of other asset classes. And keep in mind that global yields have risen, even though deficits haven't risen everywhere else. So you have to explain this in the context of, yes, deficits are up. The price-insensitive buyer, the Fed, is not there. And so there's more funding to be done. But that isn't, in my book, that's not the main driver of why yields are up. And as we go forward, clearly we have to finance the deficits, and higher yields will help do that. So right now, although we've seen a lot of shifting around in the composition of buying, households have been huge buyers of Treasuries, more than happy to take down a lot of Treasuries in the 5% region. So it's more a question of where's the equilibrium, right? And I think the equilibrium is probably roughly around that 5.25% area.
How much, Troy, do you sort of look toward new havens at a time of uncertainty? Kathy's challenging that, and a lot of people do. But still, there is a conversation. Is it Apple? Is it Microsoft? Is it gold?
Yeah, I mean, look, Treasuries are still Treasuries, so we're with Kathy on that. And to her point, the biggest asset allocation rotation this cycle has been to cash and T-bills, period, right? But one of the things as an investor you should try to do now is look for other exposures that can at least marginally produce higher return. And, one of the beauties of this bear steepener is it's taken the ability to refinance on mortgages even further out of the money. So that continues to be one of our favorite ways to play higher rates is prepayment sensitive RMBS. You have government guarantee, both implicit, explicit. You have tremendous yield. Interest-only strips hedged with pass-throughs have close to 14% yield, and you don't have the duration risk that could come from further bear steepening. So cash has been king this cycle. We like to say cash flows even better. And you have really attractive cash flows in agency RMBS relative to history and relative to the risk of prepayment in this environment.
Kathy, are you going into more esoteric instruments, or are you looking to just focusing? And I'm not saying that that's esoteric, but I'm just saying, do you have to diverge much beyond long duration treasuries at a time where there is potential that people keep highlighting of pretty significant gains should yields come back down?
Yeah, I agree with Troy on the agency MBS. I think it's a great opportunity for a lot of people, and we're seeing a fair amount of interest in it. We like investment grade corporates as well. That yield curve is flat to upward sloping, which means you can get 6 to 6.5% in relatively moderate duration of 5 to 7 years, and you're not penalized for a little bit more duration. So it enables you to kind of extend that window of cash flows into the future with a much bigger cushion than you might have, say, in Treasuries. So we're not going into low credit quality. I'd say that's the one place that we're being cautious, whether it's high yield, bank loans, et cetera. That's the area, depending on how the economy plays out. We just don't think the risk reward is that attractive. When you can get 5 to 6.5% in high quality bonds, why should you take that extra risk to get a little bit more?
Do you agree with that, Troy, sort of staying away from the lower rated credit?
Yeah, I think you really want to avoid the levered loan market in particular, just given that debt service coverage ratios have gone lower. You've also had a steady deterioration of credit quality. So if you're going to do something that's credit sensitive, make sure it's backed by a tangible asset. Performing real estate properties would be an example, or it's a newer vintage middle market lending area where you're lending after base rates have already come up, after LTVs have dropped. So you don't have as much credit risk for newer vintage middle market loans as you do, say, in legacy levered loans or older vintages in the middle market. You just have more credit risk because of how much interest expense has gone up, and you always have some degree of economic sensitivity.
Kathy Jones, Troy Gajewski, both of you, thank you so much. Coming up, the morning calls. And later, PIMCO's Aaron Brown joining us at the opening bell, looking ahead to the Fed and a busy stretch of earnings. That conversation still ahead. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Taking a look at markets ahead of the open. The Nasdaq solidly negative after a better than expected economic print. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, North Coast Research upgrading Boeing to buy, citing the plane makers promising long-term earnings potential. Next up, MoffettNathanson downgrading Lyft to sell with a street low $7 price target, expecting a notable decline in Q4 bookings and margins. And finally, JP Morgan upgrading AutoNation to neutral, seeing a more balanced risk reward after recent declines on the heels of potential questions around the resilience of auto value. Coming up, markets facing a number of risk events on the horizon. We speak with PIMCO's Aaron Brown. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Just moments away from the start of trading, and you can see a pretty boring market out there as we try to find some sort of direction. S&P futures still clinging onto some gains. Nasdaq basically flat. What we're seeing outside of stocks really might be what's driving this. We have seen a retracement in the increase in yields. We are seeing yields lower, but not by much. They were lower by much more earlier. Euro losing some versus the dollar after showing disinflation, but also a potential recessionary condition in crude just a little bit elevated. One stock to watch at the open is Caterpillar, the company reporting shrinking backlog, signaling demand worries. The CEO saying, quote, "We remain focused on supporting our customers' success and executing our strategy for long-term profitable growth." Abigail Doolittle has more. Abby.
Well, clearly investors not liking this, Lisa, with the stock down about 6%. Its worst day since April of 2022, and it has everything to do with that shrinking backlog. Now, the quarter that they reported on the surface, not so shabby. There was a 15%, nearly 16% profit beat. They put up $5.52 in adjusted earnings. Revenues basically in line, nearly $16 billion. So we're not talking about small numbers, but relative to the backlog, there was a year-over-year decline of $1.9 billion. That is the first since the third quarter of 2020, when it really had to do with pandemic supply issues and the like. So this is a bit of an outlier. And we also have Baird saying that some of the dealer inventories, well, they're continuing to grow, which essentially means that they're not going to have to order as much, showing up in the backlog. Investors nervous that this could continue. This stock now, Lisa, underperforming the S&P 500 somewhat dramatically on the year. That index up closer to 10%. Caterpillar now down about 5% on the year. And again, investors really not liking this quarter at all as the stock continues to slide right now at session lows, down about 6.5%. And that is still, I'm waiting for it to come up, that is still at one point, it was the worst day since November of 2020. So we're off of those lows, but the worst day since April of 2022.
Abby, thank you so much. Turning now to the airlines, JetBlue reporting a bigger than expected loss due to poor weather and air traffic control issues. The CEO saying, quote, "We're making improvements to drive profitable growth and ensure JetBlue is positioned for success in 2024 and beyond." Isabel Lee has more. Isabel.
Hey, Lisa, the stock is now tumbling almost 13%, and the adjusted loss will be 35 to 55 cents a share. That's much higher than the 25-cent deficit projected by analysts. Revenue will decline up to 10.5% from 2022, also missing expectations. So for JetBlue, they're banking on international travels for their growth in the next quarter. So this just really shows that some U.S. carriers have been hit harder than others. But overall, the industry is just in general grappling with the waning demand, aircraft delivery delays, and parts shortages. And this also comes in the middle of a crackdown on airline consolidation this week, in which the U.S. Justice Department claims that JetBlue's bid for Spirit would limit flight operations. For now, Lisa, shares are tumbling almost 12%, and JetBlue is down around 35% this year.
Isabel, thank you so much. Sticking with earnings, Pinterest jumping on expanding margins and strengthening growth rate. The CEO saying, quote, "We're finding our best product market fit in years. Our users are engaging deeply, and we're delivering better results for advertisers. Evidently, everyone is planning parties and decorating their homes." Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. The stock up almost 14% as it stands on track intraday for its biggest jump since October of last year, 2022. At the open, it was on track for its biggest jump since August of 2022. They're talking about making the platform more shoppable, the investments that they've made in artificial intelligence, driving the user base to make purchases in the e-commerce context based on the images that they're looking at. A beat on the top and bottom line, revenues coming in at $763.2 million, ahead of estimates. Adjusted EPS 28 cents per share. The estimate was for 20 cents. What's most interesting is the monthly active user base. 482 million users, monthly active users, is a record and eclipses the pandemic peak. But then within that is the growth narrative, and that growth is coming from ROW, those markets outside of the United States, Canada, and Europe, which makes up more than 50% of the user base. So they're seeing traction in the rest of the world region, and what they're talking about here is that investment in AI being a key factor in helping them pay off. The stock up 13.5% as it stands.
AI decorated rooms. Thank you so much. Another story in the retail sector. VF Corp falling after the footwear company withdrew guidance for the fiscal year. The CEO saying, quote, "Our transformation plan will improve our brand building and execution while addressing with urgency our top priorities." Such corporate speak this morning. Katie Greifeld, who is my Halloween pair today in orange to my black. What's going on?
It has been a brutal showing for VF Corp. Like you said, shares down about 4% right now after pulling their guidance, introducing that turnaround plan. It's really aimed to cut costs, reduce debt, and really overhaul that Vans footwear brand. Where in that specific unit, revenue dropped 21% in the fiscal second quarter, and the company warned that performance isn't expected to improve in the fiscal second half. Now, as a result, they're reshuffling the C-suite as well. Vans President Kevin Bailey going to step down. CEO Bracken Darrell will lead the unit in the interim while they search for a replacement. And of course, all of this comes while you have two activist groups circling the company. So even with these overhaul plans, Wall Street still sees a really tough road ahead. After the numbers this morning, at least 3 banks cut their price targets, 1 downgrade coming from Williams Trading, 2 hold from buy. Should Shares currently off about 3%. They had been down more than 10% in the pre-market, so some of that loss coming back. But VF Corp shares down by more than 40% year to date, Lisa.
Thank you so much, Katie. Meanwhile, stocks heading for an 8th year of outperformance in a decade. Goldman Sachs believes that will soon end, with analysts writing, quote, the U.S. equity market now has more concentration risk than other major markets. Investors should increasingly focus less on regional exceptionalism. Joining us now, I'm so pleased to say, somebody with incredible insight, PIMCO's Aaron Brown. Aaron, do you agree that U.S. exceptionalism can only go so far and that it's kind of running out?
I actually disagree with that statement. I mean, you've seen a decade of U.S. outperformance, but I think that's been really justified by the fact that the U.S. is a higher quality index. It has higher free cash flow generation than its European or other developed market non-U.S. peers. And in addition to that, in a market where you're getting, 5-6% yield on cash right now, cash-rich U.S. companies stand to benefit from being able to invest that cash into, decent yielding environments. So I think that the preference for quality, particularly in this type of cyclical environment, is going to continue to outperform. And I think that the U.S. is best positioned on a regional basis to take advantage of that.
There are a couple of questions embedded within this. Number one is how long can the U.S. ride its tech wave, right? And that's been a big question. There's also this question of whether the U.S. can get disinflation without incurring some more economic pain. Can we start on the latter to begin with? Do you think that that is possible to get that disinflation that the Fed is seeking without seeing the kind of pain in the likes of Europe and elsewhere that's transpiring?
So you are starting to see inflation come down. I think the question really is it going to come down fast enough and far enough in order for the Fed to meet its objective of 2%. I think that you'll likely see, it's probably a safe bet that you'll likely see additional financial condition tightening, at the end of this year and through next year, whether that's through markets itself or through the Fed doing one more interest rate hike. And I do think that that will get inflation down, but it's probably going to still remain sort of sticky in a high 2% range through the end of next year, which is, I think, going to be difficult for the Fed to really engineer any type of accommodation with interest rate cuts. So I do think it's a fairly fine line that the Fed is going to be facing next year. But ultimately, we are seeing inflation come down. I don't think you're going to see significant economic pain in the U.S. You may see some retrenchment in growth, but it's going to be a very low growth, not necessarily severe recession as we enter 2024.
Given that backdrop, are stocks a bright spot? Is the pain trade for stocks to keep climbing because they are cash rich? They're able to capitalize on an economy that's not sinking dramatically and, frankly, are in pretty good positions, especially with their tech leadership.
So I think you're going to see real differentiation emerge as we move through 2024. You saw some of that this year, and I think you're going to continue to see it next year in terms of differentiation between the high-quality stocks and their lower-quality stocks. Right now, stocks are competing against a yield-rich environment on the fixed income side, which is, yielding you, north of 5% on cash. And so that's a difficult environment for equity investors as a starting point. So, for companies that aren't delivering with respect to earnings, with respect to sales, and with respect to free cash flow, there's another alternative out there right now on the fixed income side, and it's a safe haven asset. That said, I think that high quality companies that are able to generate growth and free cash flow will, continue to do well in 2024, because I don't think we're going into, a recession. And if we do go into a recession, it's going to be, a fairly mild one. And so in that environment where you have, slow growth, but not necessarily severely negative growth, stocks that are able to generate, good returns, good earnings are going to continue to do well. So I think, you really have to pick your spots as you enter next year.
As you pick your spots, and it is selective, I'm curious how you're allocating, given the fact that the ballast of bonds has shifted and that the ballast of stocks has become more idiosyncratic.
So I think that, particularly good quality, high, investment grade fixed income instruments, I think should continue to do well. Agency mortgages, I think, look very cheap. Even non-agency mortgages, structured products also look, relatively attractive in this environment, as does high quality fixed income broadly. Some equities, I think, also look attractive, but where we're really staying away from are equities that are really dependent on a easy interest rate environment. Some stocks like the home builders, like consumer autos, have done really, decently well this year, particularly the home building sector. But yet, an 8% mortgage rate is going to really start to bite next year. And so I think that those are the stocks, the ones that are consumer facing, but also highly dependent on easy credit. Those are the stocks that I think that are underperform. Broadly speaking, I think the equity market will have sort of low, sort of flat growth next year in terms of the total equity return. But I think you will see real differentiation between, those stocks that can internally generate its own growth and cash flow versus those that are really dependent on an easy financing condition, which are going to be hurt, I think, even more so next year.
Within the credit sphere, you're talking about some of the more interest rate sensitive on the equity sphere. In the credit sphere, there's been a lot of befuddlement about why we haven't seen more pain. Former Fed Governor Jeremy Stein was quoted in a Bloomberg piece today saying, if you had told me 2 years ago that the Fed would hike by this much in a short time, I would have said that they would leave dead bodies littered across the corporate credit landscape. A lot of people would have agreed. Is that deferred, delayed, or just put off indefinitely?
I think it's a little bit of both. I think, firstly, you've been in an environment with over a decade of super low interest rates where corporates have termed out their debt. And so you haven't seen, significant debt maturities coming due over the last couple of years. And I think as a result of that, companies have been able to hold in there. If you look at interest rate costs in the U.S., they haven't, increased in terms of the aggregate share of the corporate balance sheet that much. And corporates that are cash rich have actually been able to take advantage of this high interest rate environment and reinvest their cash flow into higher yielding money market funds or cash funds. And so as a result of that, you haven't seen corporate credit pain. You also haven't seen household pain either, because similarly, households have been able to term out their debt structure through the 30-year mortgage, which is why you're seeing a different outcome in the U.S. with respect to, non-performing loans versus other more interest rate sensitive economies. That said, there's only so long that this can last. And so you are seeing cracks in the levered loan market. You are starting to see some cracks in the floating rate market, as well as the, more distressed high yield market. I think that those are going to be more idiosyncratic stories. We don't have a significant debt maturity wall until the end of this decade. And so I think by and large, corporates that are, investment grade should hold in and be okay.
Erin Brown, thank you so much, as always, for your insights. Coming up, Apple unveiling new products ahead of Thursday's results.
The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened.
Can Apple earnings help big tech get its mojo back? That conversation coming up next.
The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened. I'd be very interested to see how the Apple numbers are received. I suggest, again, there will be a proneness among investors to look for the holes, look for the cracks, look for any weakness, simply because the Magnificent Seven have been priced for perfection.
Tech results continuing to roll out with Apple in focus ahead of its Q3 earnings report. That comes out on Thursday. The company unveiling a new iMac laptop and third generation of its in-house processor line at its Scary Fast event last night, which is fantastically themed. All eyes are on the new M3 chip lineup, which relies on advanced tech to boost performance and graphics horsepower. Joining us from San Francisco, back for more, is Bloomberg's Ed Ludlow. Ed, how much does this really move the dial ahead of earnings in 2 days?
Well, Well, the timing is curious. It was scary fast, by the way, about 30 minutes, the shortest Apple product unveil that I've seen. But of course, nothing that was announced across the new Mac lineup is going to have an impact on the fiscal fourth quarter, which gets announced Thursday. Basically, what we got is a new iMac and 3 variants of the new MacBook Pro, all powered by 3nm M3 chips. It's the first time that any volume producer of PCs has put a 3nm built chip into their hardware, and there's a sort of ascending scale, M3, M3 Pro, and M3 Max, which as you go up that ascending scale has an increased number of CPU cores and GPU cores and performance. And what Apple is hoping on, the outside of the fiscal fourth that they report Thursday, is this puts them back on track in the PC market. Something the sell side's responding to this morning is looking at what's announced and saying, okay, this could drive an upgrade cycle for consumers around the world who either have the Apple hardware that has the M1 processor, the first generation of Apple in-house silicon, or they have the most powerful Intel-powered PCs. Yeah. And something that Apple said during the presentation is that their most powerful MacBook is 11 times faster than Intel. That's the battleground. The expectation Thursday, 4th consecutive quarter of overall sales decline, which the market is bracing for.
Well, that's exactly where I wanted to go, Ed. Just quickly here, just to underscore the point, how much is this trying to give some decoration to take the noise off of what they're going to report on Thursday?
Yeah, it's worrying because you have to go back more than 2 decades for Apple to have 4 straight quarters of sales declines. They've been candid that in North America, the PC market and the smartphone market is weak. China was a bright spot in the fiscal third, but the third-party data says that China won't save the day this time around.
Ed, thank you so much. As always, wonderful reporting. Sticking with tech, Apple isn't the only company set to report earnings this week. With results from chip giants AMD and Qualcomm still in the pipeline, Katie Greifeld joining us for more. So far, the story very much, Katie, has been the reaction to some of these earnings, which has been punishing, particularly for anything that's amiss. What are you watching?
Yeah, that's the word to use, punishing. It has been a punishing earnings season so far. We still have plenty of mega caps set to report earnings, and we'll see if they can reset the narrative here, because so far, before we get to Apple on Thursday, we have Qualcomm tomorrow, AMD after the bell today, and this is really a tale of 2 chip giants. You take a look at AMD, and successfully taken on Intel. It's aiming for NVIDIA's fortune with its new AI accelerator chip. All of that has powered AMD to a 46% rally year to date. Then you take a look at Qualcomm. Meanwhile, it's been plagued by sluggish smartphone demand, prolonged inventory struggles. All of that has left shares about 2% lower year to date. It's going to be really interesting and important to see how this settles over the next couple of days.
At this point, we've been seeing that those that beat kind of get like a tepid applause, and those that miss see their stocks tank. How much is this even more so for the big tech sphere, the Magnificent Seven, given the fact that those shares have driven the gains so far this year in headline indexes?
Well, that's the thing, Lisa. Investors are really looking for a reason to either justify the rally or to actually resume their buying. And so far, if you take a look at the commentary, if you take a look at the numbers, that really hasn't been provided. And the stakes are a lot higher after we've seen these double-digit rallies and then some from some of these really huge companies.
At this point, Katie, is there one sector that's outperforming, or is it pretty much story by story, company by company, execution by execution?
You know, that's what I've been looking for, and it feels really idiosyncratic at this point, because you have the likes of McDonald's that still have pricing power, for example, and then you take some of their retail peers, and it just doesn't exist. So it really depends on the company, on the C-suite, and really what their actions have been to this point.
Katie, thank you so much. My partner in crime when it comes to Halloween decor. For some of the sector price action that's really getting our attention this morning, let's head over to Bloomberg's Abigail Doolittle. Abby, what you see out there?
Well, Lisa, we have this small loss for the S&P 500 right now, down about 1/4%. Not surprisingly, most sectors are lower, but not a ton of drama beneath the surface, as John would like to say. Tech is the worst sector, down about 0.9%, and this even as yields are lower, so we're not getting any relief there. We also have energy, communication services down, real estate and utilities. Well, because yields are down, those of course are the dividend-rich sectors, so those dividends look a little more attractive this morning. Those sectors are bid higher. Now, earlier we were talking about JetBlue, those shares plunging. Isabel Lee, I should say, was talking about it. And the airline index, even though JetBlue is not a part of this index, today and over, frankly, the last month and from July even, down sharply. But this month down about 17%. Some of the big airlines down in sympathy with JetBlue.
Costs going up and not able to pass it along to the customers in the same kind of way as places like McDonald's. Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. Finding a little bit of weakness as the session grows older. A spooky morning on this Halloween. A question of NASDAQ underperforming, down 0.6%. Time now for the Trading Diary. What you need to be watching this week. U.S. consumer confidence coming at the top of the hour. Wednesday, FOMC rate decision followed by Chair Powell's news conference, and of course, the Treasury refunding announcement, as well as ADP private payrolls. And JOLTS data, it's really a massive week for labor market data. Thursday, more data, including jobless claims and durable goods, Apple reporting earnings, and Friday, the October payrolls report. Right now, what you are seeing in market is a fading after the employment cost index came out better or hotter than expected. This was Countdown to the Open. John should be back by tomorrow. This is Bloomberg.